After 56 records in a row, the S&P 500 at almost 6,100. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Fed Chair Powell says the U.S. economy is in remarkably good shape. Investors are now paying attention to Friday's jobs report.
And a record-run Bitcoin tops $100,000 as President-elect Trump nominates Paul Atkins to lead the SEC.
And a string of corporate news to digest. We'll dig in as American Airlines takes off and discount retailers show some signs of progress. But let's take a look at where markets are trading right now. We had a big day yesterday led by big tech. Right now, another bit of a breather. This is similar to what we saw yesterday morning, so we'll see what holds. But the S&P 500, the NASDAQ 100, pretty much unchanged at the moment. You take a look at the bond market, also relatively calm, relatively speaking, to the last few weeks. The 10-year yield higher by about 3 basis points. We are back above 420, but of course, the focus for the bond market is on that jobs report coming tomorrow morning.
Yeah, and every day this week we start off soft and then we build up to another new record.
Makes it hard for morning show anchors.
Yeah, take a look at this chart. I've got, although you can't really see it, the S&P here, I've got the NASDAQ here, I've got NVIDIA here, but the only line that charts is Bitcoin. It's got a 128.5 million% increase since 2009. To put that in perspective, this red line is NVIDIA with a 39,000% increase. So it just blows everything else away.
But it started from zero, but now we're at 100,000. Really a historic rise. We're going to watch some stocks as well. That's Kroger sales had disappointed. It missed estimates last quarter, narrowed its forecast guidance for 2025. It awaits a court review on its proposed merger with Albertsons. You're looking at Kroger shares now down almost 0.2%. Keeping an eye also on Dollar General. Have loved talking about the dollar stores, really giving you more of a picture on what's going on across rural America as well. 2% higher this morning. That is because comparable sales were higher. Really, we've been talking about Bitcoin. You are seeing the love in other Bitcoin-related stocks. Remember that soaring past 100,000 for the first time ever after Trump picked that pro-crypto advocate Paul Atkins as his choice for SEC chair. You see crypto-related stocks, especially MicroStrategy here, just soaring. MicroStrategy up almost 9% this morning, Matt.
That's right. Also, Vladimir Putin talking about the potential for a Bitcoin reserve. Putin on the same page with Donald Trump. In terms of the big movers, industrials are really where it's at this morning.
That's true.
And I'm talking about the airlines, baby.
We're talking about the airlines, of course. Some interesting news when it comes to American Airlines basically boosting their adjusted EPS look. We saw something similar from Southwest and JetBlue. I actually want to go back to crypto, not to shock everyone.
Oh, really?
I know. For once,
I thought we were going to focus in on AAL.
It's interesting. All we needed was a catalyst. We finally broke above 100K, but remember Gary Gensler and the hopes and dreams that were pinned on Gary Gensler? He was seen as crypto friendly. He taught that course at MIT. And then, we saw what reality held for us. So it'll be interesting. There's all this optimism over Paul Atkins. We'll see if it holds.
We're going to talk about it later in the show. Crypto, of course, soaring on the heels of that new SEC chair news. But also, remember, Gary Gensler was cracking down on a lot of things, like ESG, for example. He was very worried about climate. Does that mean energy takes off, too? I don't know. I have no idea, Matt.
I mean, I think, obviously, if Paul Atkins disappoints the president, he will be fired. So it's different than Gary Gensler. There's one man running everything.
That's true.
Starting next year.
Starting next year. Let's talk about next year, and let's bring in Jay Hatfield. He is Infrastructure Capital Management founder, CEO, and portfolio manager. Jay, it's great to see you in person.
Thanks, Katie. Thanks for having me in.
I want to talk about next year because I want to talk about your year-end price target of 7,000. That's interesting because it feels like a lot of the sell side has coalesced around 6,500 for their year-end target. What gets us to 7,000 this time next year?
Thanks, Katie. Well, it's really just one and only one thing, and that is corporate taxes. So we think everybody has gotten distracted by the nominations and a lot of the hangover from the election, which is all around tariffs and deportations. But really, there's only two things that matter with this new president. The first is corporate taxes, and we won't know that for a while. So That's why we're sort of calling for a stalled market, or at least just a slow grind up, which is what we're seeing right now, and then a later rally. But if that corporate tax cut doesn't happen, we would have a consensus 6,600 target, because kind of our insight during this cycle was around monetary policy. Monetary policy is relatively locked in. So we would just have a normal 10% increase in the market. We had a 6,000 target since June, but we're really focused on the corporate tax cut. If we went to 15, our targets would be 7,500. And this is really just arithmetic. This is not like looking up into the skies and talking to God. It's just that when you lower corporate taxes, yeah, you have more earnings, and earnings grow faster because you have better returns on invested capital.
How impatient are investors right now? Because that normal way 10% gain feels like not a lot when you look at almost a 30% gain this year in the S&P 500. Do you chase other asset classes? Do you chase other sectors to try to get above that 10%?
Well, the other factor that's material, because you know, if you really look at the Biden administration, not a lot happened, really. Nothing really changed. But there's one thing is probably the biggest change ever is in antitrust enforcement policy. And so we're super bulled up about the investment banks. Morgan Stanley, Goldman Sachs in particular is almost a pure investment bank. Jefferies on the small cap side. And so we're carrying numbers 30% above the street. The street's usually very slow in updating numbers, so that's where the buy side has an advantage. So we're assuming peak earnings from investment banking. And so we're likely to have really a boom in mergers next year.
And we should say at the top of the next hour, we're going to be speaking with Morgan Stanley's co-head of investment banking. We'll see if that bullishness will come to play.
Your very bullish target, though, Jay, if I'm not mistaken, is reliant on a much lower Treasury yield. I mean, we're at 420 right now. We've been as high as 450. And if we get tariffs, if we get deportations, mass deportations, as the sign said at the RNC, doesn't that, boost inflation? Doesn't that hinder the Fed from cutting? Doesn't that hold rates high?
Well, what people aren't focused on is there's $56 trillion of global pension assets, and our rates are the highest among the highest. 56 trillion,
that's about the same as like the national debt, right?
Well, it's roughly twice the national debt.
They're in the same ballpark.
But they do rebalance. And so everybody's kind of ignoring that. We had this big sell-off in treasuries, and we said this at 450 on the treasury as well. So we've had 30 basis points of rally. But there's going to be a rebalance primarily at the end of the quarter. We're going to get much slower inflation year over year in the first quarter. We're rolling off 1.1% of inflation in the first quarter. So in other words, we had a 0.5, 0.4, 0.3. So likely to see decelerating inflation. The Fed will still cut. So we're more bullish about rates than most. And we actually think inflation is declining and not increasing. We're focused on the money supply and not what all the Keynesians.
Not the deficit and debt. I mean, maybe you think Doge is going to have some teeth because you're thinking low inflation and you're thinking 10-year with a 3 handle, right?
3, but we did raise it, to be fair, because we adjust our views, so we don't go down with the ship. But we were really more at 3.25. We think faster growth, which is what we're likely to have, will put more demand and more mergers. You're going to get buyouts and debt offerings. So we have adjusted our target to 350 to 4. So really backed it up 50 basis points. But we do think that's going to be primarily driven by growth and not inflation. In fact, we think that right now we're almost in deflation because we have an adjusted way of looking more real time at what is the inflation rate.
Sure, you have your own inflation indicator.
Right, and we've adjusted it to look at rents, not just housing prices. So we're right now at 0.6 on PCE. And of that, most of that comes from auto services, which is a hangover from the pandemic.
Right.
And the money supply is dropping. So we think we could have negative inflation prints. I mean, if you adjust it, we may never get there because shelter could be 100 years before shelter goes down to 2%. God only knows what they're doing back there.
Jay, there's so much to dig into, not a lot of time. I have to go to this line in your notes because you're right. The Fed is fatally flawed and needs to be reformed. Those are fighting words, Jay. What does that mean?
Well, nobody really recognizes it, but the Fed caused the Great Recession. They stuck to a 2%. It wasn't a 2% target. It was a 2% ceiling. And they raised rates 17 times in a row. They nearly created a recession in 2018 using that same completely arbitrary target. And then they fueled this huge inflation. So they've really done a horrendous job since the 2% target came in, and they don't want to change it. So we really need some outside force to come in and say, let's revisit this 2 to 3% target, be more flexible like we had with Greenspan, use this thing called judgment instead of rules, and avoid these huge policy errors that are often defended by the status quo. People like Bernanke come in and do studies about how wonderful their monetary policy was.
I always forget to plug it, but on infracapfunds.com. That's the website, right?
Right.
We can see your CPIR, your adjusted inflation indicator, and I think it's fascinating stuff. Jay, great having you on set. Thanks so much for joining us. Infracapfunds.com. Check out the inflation indicator there. I want to get to American Airlines, though, because the company raised its profit expectations by a lot for Q4, joining other U.S. carriers this week. We've had JetBlue and Southwest, I think, also doing that, expecting stronger travel and more profitable travel. Let's go over to Berlin right now. Bloomberg's global aviation editor, Benedict Campbell, is standing by. And Benny, what's driving this big boost to EPS outlook?
Hey, Matt. So people are traveling again. People are on the road. We saw the numbers during Thanksgiving. 80 million people on the move, a lot of them obviously by car. But really, an increasingly large number of people are flying again, are sort of rediscovering air travel, be it for shorter trips or for longer hops over here to Europe from the US. And that's really benefiting the airlines. American coming out today saying that the fourth quarter is looking better. The environment overall for revenue and also for costs is looking better. They're bringing down costs. People are the demand is there. And as you said, that follows the likes of Southwest, JetBlue, and is really supporting the stock. It's taking quite a pop this morning. It needs that encouraging nudge. Didn't do so well so far this year, but overall the picture looking pretty good for them right now.
What do we know about pricing power here? If there was so much worry about the supply in flights in the whole of the year, do we know now that there's more of an equilibrium, that the airlines have that power back?
They seem to still have the power because, as you say, the supply side is still fairly constrained, given everything we've reported about with Boeing, with Airbus. A lot of airlines still don't get the planes that they'd want. The seat numbers are still constrained, and people are traveling again. So they still have some pricing power. At the same time, there is the cost side that is really coming down, in particular on the fuel side. That is the single biggest cost for a lot of the airlines, and that they've been able to keep that under control, and that's really helping them.
I actually want to talk about United in some detail here, because you take a look at the
year-to-date. A lot of curveballs here.
I was playing with the charts this morning. I took a look at the entire group, and I saw United in blue there. It's up 140% year to date, which is fascinating because up until August, they were all trading as a block. What is going on with United Airlines, Benny?
Yeah, so it's not exactly Bitcoin territory in terms of the gain, but yes, 140% up this year. That would put them on track for their best annual return since 2010, to put that in perspective. Really, the stock took off sort of in October. That's when people really started buying into the shares. They had pretty good numbers in October. They've done a lot of things right operationally. The costs have come down. People are rediscovering things like in-flight Wi-Fi. They're bringing costs down, not just on the fuel side, but sort of operationally as well, in terms of taking out some unprofitable routes and so on. So people really like the story. If you look at the analyst ratings, most of them are at a buy right now. I think there's one lonely sell rating. So really United leading the pack. But it shows you that not everyone is in that same line. I mentioned American quite far behind in terms of the annual performance. But people really seem to like what United is up to right now.
Bloomberg's Benedict Campbell, we thank you so much for keeping an eye on all these airlines for us. You know, Matt, it really frustrates me because if you take a look at where airlines are classified, they're as industrials.
Yeah.
There's a reason this annoys me, because you look at the rest of the travel stocks and they're actually very much trading behind the broader S&P 500. That would imply that you have more room to run if you're buying into hotels instead of airlines, for example. If you fly, don't you need to buy a room too?
Yeah, no, absolutely. I mean, I think there's such a close connection to the oil price as well. Obviously, jet fuel and personnel are the two biggest expenses. Yeah. But it is interesting.
It's also capital intensive. You have these massive planes with, et cetera, maintenance issues and all that.
But things that are classified, like, so Ferrari is classified as an industrial. Clearly, that's a luxury business, right?
True.
So there's a lot of things in industrials. Okay, we have to go to break. Paul Atkins picked by President-elect Trump to lead the SEC. We're going to take a look at what that means for Bitcoin, for stocks, for the commission. Next, this is Bloomberg. Now let's get to high interest. Look at what's making headlines around the world. The suspect in the NYC killing of United Healthcare CEO Brian Thompson remains at large. A search warrant is being sought in connection with the suspect, according to a report from ABC. The report, which cites unidentified sources, said the police now appear to be closing in on the identity of the shooter. Meanwhile, over in South Korea, President Yoon is set to face an impeachment vote on Saturday after the fallout from his martial law decree. But the country's ruling party, which opposed the martial law order, has said it will prevent the impeachment motion from passing. The South Korean won has yet to fully recover from the political uncertainty so far. And speaking of political uncertainty, yields for French government bonds actually fell after the leader of France's far-right party told Bloomberg that France can overcome its government collapse in a matter of weeks. But Marine Le Pen does not think the country's current crisis calls for the resignation of its president, Emmanuel Macron.
En tout cas, ce que j'ai dit, c'est que la démission du président de la République.
What I said was that the president's resignation is a personal decision for him and can only take place, in my view, when a political crisis happens or an institutional crisis can no longer have any other solution than the resignation of the president of the republic. What I do wish, on the other hand, because for sure there will be new legislative elections in the next few months, is that we work on a voting system by then that enables us to have a real majority, whatever that majority may be. But the country needs a majority. It can't live for months and years with 3 blocs, which in reality can't implement a policy.
We're going to now move to American politics, because now you have a crypto rally just soaring to new heights after President-elect Donald Trump announced his new pick to head the SEC. He selected Potomac Global Partners CEO and founder Paul Atkins to replace outgoing Commissioner Gary Gensler. For more on Atkins, we are joined by Nathan Dean. He's senior analyst of U.S. policy at Bloomberg Intelligence. And it's crypto. That's pretty clear that there's going to be big changes there. You have Paul Atkins, who has worked with a number of crypto stablecoin related companies, tokenization companies. But it's also a whole host of other things, isn't it, Nathan? Because you had Gary Gensler cracking down on everything from climate disclosures to texting at a hedge funds, record-breaking fines. How do you see the financial world changing?
Yeah, so, obviously crypto is very important. It punches above its weight when it comes to the SEC in particular. And what we think Commissioner Atkins, he was a commissioner of the SEC back in the early 2000s. There's really 3 things that I think he's going to be focused on. Let's start with crypto. Essentially, with the rally that we're seeing right now, and especially what we're seeing with Coinbase and Robinhood, there's this idea of the loosened enforcement risk. There's not going to be an enforcement albatross hanging over the crypto sector's neck with Commissioner Atkins as SEC chair. He's going to be looking at capital formation, maybe changes to the accredited investor definition, getting the ability for private individuals to look into startups and private markets to be able to invest more. And then third, which is most important, I think, to him, is this idea of deregulation. Everything that Chairman Gensler has done is on the table for being rolled back. But there's no magic wand here. Commissioner Atkins can't just come in day one and say, deregulate. There's a process that's a lengthy process. So I think you're going to see a lot of these rules that Chairman Gensler finalized are now in the courts will continue in the courts because that's the fastest way they can get overturned.
And that's good perspective. Again, it's not a magic wand here. There is still a process. I want to talk a little bit more about crypto because obviously you can see the enthusiasm in the price alone. We were talking about it at the top of the show, though, that Gensler was seen as very crypto positive. We know how that went. Tell us a little bit more about Paul Atkins' background and how committed he actually is to the crypto space.
Yeah, so Commissioner Atkins obviously has been working with the Digital Chamber of Commerce on crypto. It's very much seen as a pro-crypto, but also stepping back a little bit, he's more free markets and pro markets. So what does that mean for crypto? Well, for the first step, I was talking about the enforcement albatross. That's most likely gone. The second step is there's a lot of firms out there like Coinbase and Robinhood and so forth that want regulatory clarity from the SEC. And I think this is where Commissioner, if confirmed, Chairman Atkins will come in and provide that clarity. So if you are a token and it's deemed a security, here are the registration requirements, the compliance requirements, and so forth. But where we're cautioning the cryptocurrency industry on this, however, is that Congress also wants to play in this space. And so we think Congress is going to pass legislation next year that will essentially direct the SEC to promulgate new rules. It'll be up to Chairman Atkins to actually go forth. So he may not be able to put his own personal views, but first year, half next year, it's this enforcement loosening up. Second half is most likely going to be putting out new rules to give clarity to these firms.
All right, Nathan, really appreciate that quick breakdown. Have to have you back soon. That is Nathan Dean of Bloomberg Intelligence. Now, coming up later in the show, the market outlook with Morgan Stanley Global Co-Head of Investment Banking, Eli Gross. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. A quick check on futures with moments to go until the bells ring. You can see the S&P 500. The color is red, but it's pretty much unchanged. We'll see if we can get a 57th record high today. The color just has to be green, so we're not talking about big moves here. You take a look at the NASDAQ 100, also back to unchanged despite a big rally yesterday. The Russell 2000 still in the red, down by about 0.3%. Now, coming up less than 4 minutes until the opening bell, we'll discuss the market moves with Gustavo Medeiros. This is Bloomberg.
All right, we're moments away from the start of trading after a 56th new record on the S&P 500 yesterday. Can we hit it again? Well, futures right now are unchanged on the S&P. The last few days, we've been talking about a soft open and then we rise to a record at the end of trade. Maybe that'll happen again today because the NASDAQ futures unchanged as well. Russell 2000 futures down. They've rallied from losses the last couple days as well. You hear the opening bell. Tractor Supply ringing the bell down at the NASDAQ market site. This stock, by the way, has more than doubled. I think it's up 220% over the last 5 years. They've done very well selling farm life equipment. And at the New York Stock Exchange, who's ringing the bell at the New York Stock Exchange? I see a lot of
Body Works.
Bath and Body Works. That's not a bad stock either. That's up 180% over the last 5 years. So a couple of winners ringing the bell. In terms of the major averages, Katie Greifeld, what do you see?
I want to talk more about tractors and hand lotions because you take a look at the screen right now, not too much to talk about. The S&P 500 pretty much unchanged. Like Matt said, that can change, and we've been watching it change, of course, as we get closer to the closing bells. But a quiet open on the NASDAQ 100 as well for your big tech names. This was the big outperformer yesterday, finishing about 1.2% higher, so a little bit muted at this open. And then you take a look at the Russell 2000. It was down to the tune of about 0.3% pre-market. Now pairing some of those losses, we'll keep an eye on the small caps. But let's get specific here and let's talk about Kroger's because sales missed estimates last quarter, also narrowing its forecast guidance for 2025. It is, of course, awaiting that court review on its proposed merger with Albertsons. We've been waiting for that one for a while. Shares down about 1%, Shonali.
Yeah, you've got to wonder if the new world of antitrust will help that one out. I'm looking at another sector. I'm looking at consumers. Dollar General, it narrowed its full year guidance as years of price increases across the economy continue to squeeze the core base of low-income consumers. Yet you are seeing Dollar General get some relief. Despite the challenges, it showed signs of progress in the latest quarter. Comparable sales rising 1.3%, the stock rising 1.5%. This was a stock otherwise down more than 40% this year, Matt.
Yeah, they've had a tough time, as well as Dollar Tree this year, but results boosting them a little on the day. American Airlines boosting its results, or it's boosting its expectations, I should say, its outlook for the fourth quarter, joining a couple of other U.S. carriers in doing so. We had Southwest and JetBlue also saying it's going to be a strong travel season this Christmas and a more profitable travel season as they do that. Obviously, the shares go up in American Airlines case 9%. 1%. I also want to take, speaking of going up, I want to take a look at crypto right now because Bitcoin pierced $100,000. Right now we're trading at 102,622. Trump's SEC pick helps. Paul Atkins, he's more crypto friendly. And I think it also helps that Vladimir Putin gets on the same page as Donald Trump and talks about putting together a fund of Bitcoin. It's more reliable than the dollar for the Russians. Let's bring in Mike Regan right now, Bloomberg's global crypto editor. Mike, I guess we knew it was going to happen, right? It was almost inevitable. But what are the drivers here?
Yeah, it really did seem inevitable, though it hit that 99,700 level like almost 2 weeks ago and then really turned around. So there was clearly some really strong resistance right at that 100,000 level, whether it's just that typical round number resistance. There's also a lot of options outstanding right at that level. But it did, you're right, it did feel inevitable. The news on Paul Atkins, very crypto-friendly pick for the SEC was confirmed late yesterday. Also, one of the Trump cabinet nominees that's probably going to have a much easier road through confirmation than some of his other picks, which is, also something I think the industry is taking note of. But I would also point out, Matt, the timing is really interesting because it was really, it was like 9:30 at our time last night, right at the morning of the Asian hours. And when you look at what's going on in Korea with the won weakening, the Kospi weakening, crypto trading has become so huge in South Korea that now that on a dollar value basis, it's actually bigger than the equities trading in Korea.
Wow.
So I wouldn't discount sort of the bullishness and sort of even crazy to sound, but a haven trade in Korea for Bitcoin, given the time of night where
Not crazy to me, brother.
Yeah.
A lot of macro moves going on, but also, can I just say, I'm a bit impressed by the financial ingenuity here that you see among crypto traders. Can you explain this arbitrage trade that's going on with MicroStrategy's notes?
Yeah, it's sort of complicated, but to really boil it down to simplicity, MicroStrategy is doing two things. It's offering actual equity, secondary equity offerings, and these convertible notes. And it's become a very popular hedge fund and retail trade. Retail is very all in on the stock and just buying and going along the stock. But there's also this trade where some hedge funds are going in and out, shorting and going long the stock, but also going long the convertible arbitrage. And it's almost become this mini asset class of itself, MicroStrategy. When you look at these ETFs that track it, just that single stock and lever up on it. So MicroStrategy has become this sort of phenomenon in itself, completely detached from really the core underlying software business that's at the heart of it, and really become this really speculative play on the direction of Bitcoin.
All right, Mike Regan, great to see you. You're a busy guy, so I know you got to get back to the desk. Matt Miller, I know that everyone makes fun of you for buying early and then selling early. How do you feel today?
Yeah, I feel, it's horrible because 11 years ago, I bought a Bitcoin on this set from Max Raskin. I tweeted out a clip of that, and I spent it.
$800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot, by the
on
way.
beer and groceries and gas and video games
And hogs.
I wish I had kept it. I would buy a Harley today if I had.
Yeah, but you probably
that
wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and a beer in my hand. Let's talk right now about expectations for 2025. Market trends that we can look forward to with Ashmore Head of Research, Gustavo Medeiros. He joins us here on set. Can I call you Gus?
Yes,
Do people
absolutely.
call you Gus?
Thank you very much.
Gus, great to have you here. You are focused at Ashmore in London on the rest of the world, on EM, really, and we're watching this incredible sort of U.S. exceptionalism rally just extend. Does it get lonely in the rest of the world? Or, do your clients want you to shift your focus? How does it feel?
It does feel a little bit lonely, to be honest, but it's not a terrible feel. I think that the U.S. exceptionalism has been extended, and you're right. If you look at valuations today, we're just around 26 times earnings, right? And that implies, an earnings yield of around 4.5%, just slightly under 4.5%. So you can think about it in a way, if you are only pure dollar-based investor, why bother buying an asset that has a volatility of 10 to 15% per year if you can actually sit in cash with very low volatility and get exactly the same earnings yield? Actually, quite a lot of renowned investors have been doing that. And the fact of the matter is that there's quite a lot of positive things going on for America. And this is a great economy, and it's been surprising to the upside most analysts. But there's quite a lot of anticipation for how this economy will remain great for 2025, 2026, and beyond. And I think this anticipation is already basically pricing in. So these levels of valuations are already pricing in a phenomenal economy, a great market. And I think that there's a lot more room for disappointment from here.
Yeah.
So this is an asset class that has more left skew, if you will.
And there doesn't seem to be a lot of hedging, right? I mean, we don't see people taking out that much insurance on the potential correction here. And I wonder, if I look at it inversely, do you see people getting in, edging into emerging markets, maybe buying options on the potential of a turnaround there?
Yeah, I mean, I think that's the crux of the matter, right? I think most investors that are building a portfolio, they're not thinking about upside, downside, although that's been quite a lot of the trading in 2024. People are afraid of losing the upside and buying options and then driving markets up. But most people are trying to build a portfolio for the long term. And this is where it becomes a bit of a no-brainer, quite frankly, to actually add exposure to the rest of the world. And the cheapest asset class in terms of like historical basis are in emerging markets. We're just talking about crypto. Dogecoin last night before Bitcoin went through 100 was trading at $62 billion market cap. Now, at $62 billion, this is basically, larger than many companies in Brazil. It's 50% larger than Itaú, the best-run private bank in Brazil. It's about the same market cap of Nubank, the best-run financial kind of bank in Brazil, fintech in Latin America that is doing extremely well. The meme coin environment, it's close to $120 billion, which is larger than Petrobras and Vale together. It's about 50% larger than SK Hynix, which is a phenomenal chip-making company in South Korea. Obviously, it's a global business, right? So we're talking about the level of exuberance, and you can see that in these corners of the market where leverage does matter and plays a big role, that kind of get overextended. And obviously now everybody wants to have more and more of the U.S., with Doge being the deregulation and actually leaning down the government, which is a great
government efficiency.
Thank you very much. Yeah. Now it became a meme government program rather than a meme currency, and perhaps that's why it's getting to new highs.
Gus, it's great context because some of these comparisons really make your head spin. I want to talk about China, though, because the phrase EMX China has, I hear it so much more in the past couple of years than I did the years previous to that. And you think about where China is right now, how much of a driver is it for the rest of the EM bloc?
It's not as strong of a driver as it was in the past. I think there is quite a lot of growth that is taking place in emerging markets over the last 2 years have been EM ex-China growth. There was a huge amount of countries that actually did structural reforms and macro stabilization plan coming post the COVID crisis that actually led to a much better growth environment, a much better macroeconomic environment. If you look at upgrades versus downgrades, there are many more countries being upgraded than downgraded over the last 12 months, and that actually is being translated into a very resilient performance on the fixed income market. The equity market, both overall emerging markets and China, we're actually doing quite well. Actually, China is outperforming many equity markets in the world year to date on the back of these PBOC policies that were announced in September. China has a lot of economic problems and a lot of macroeconomic problems, but they have what it takes to actually solve them themselves. What our thinking has been is that since they've announced the monetary policy bazooka in September, the fiscal bazooka, it's actually loaded and waiting to be deployed. But actually, they've been waiting to see what happens in terms of the new administration, whether or not there's going to be an aggressive trade war. Because if there is this sort of headwind, then the sort of fiscal policy may be slightly different.
Well, to that end, how do you roadmap? How do you game plan what the Trump tariff policy might ultimately be?
So I think that you have to think about scenarios, right? And the most aggressive scenarios are basically Trump is going to do everything that he promised on the campaign trail. Very aggressive immigration, kind of like, deportation, mass deportations, very large tariffs across the board, and specifically to China. And that would be a very negative environment, right? But I would say that kind of like the U.S. stock market is also very, very far from pricing in. Donald Trump, as we know, he does care about the stock market. He's been monitoring that and tweeting about that constantly on his first mandate. I think, again, particularly considering how much the stock market is anticipating, there is no way that with these aggressive policies you can actually see a new all-time highs throughout 2025. Why? Because if you do get towards these more aggressive tariffs and immigration policies, that is going to have an impact on inflation, that is going to jack interest rates up, and that is, that's that's going to knock down the valuation of, assets that are overly exuberant, such as high PE and high multiple stocks, and obviously these other parts of the asset class. Whereas if you look at China or EMX China, you actually have tremendous opportunity, a lot of bargains. China is actually allowing for the companies to buy back their stocks, lending money directly to the companies at 2.25 percentage points. That's a tremendous backstop, right? And again, there's quite a lot of fundamentally positive stories going on in EMX China that have been ignored because of these UX exceptions.
By the way, just really quickly, can you see a parallel can you roadmap Trump by looking at what Milei has done in Argentina?
Well, that would be a phenomenal, I think that would be a great parallel, because if you think about the first trade war, there was a focus on the bilateral trade, the bilateral deficits, right? And that is a narrow focus that is self-defeating, because the genesis of the external imbalances from the U.S. are the local imbalances, the fiscal deficits that are very large. That runs the large current account, the twin deficits that it has been running for over 2-3 decades now. Now, if there are thoughtful policies, and tariffs are a mechanism to get a grand bargain, as Scott Bessent has been saying, and if the U.S. fiscal deficit is going to be consolidated towards 3% by the end of the Trump administration. Now, that is a framework that can actually lower these imbalances. That would be actually positive both for the U.S. stock market and for the rest of the world. But I think that in that environment, the valuation of stocks in the rest of the world tend to outperform, because there would be a huge relief rally across assets that have been actually trading at distressed levels. And quite frankly, some of them have been trading at humiliation kind of levels in terms of sentiment.
Gus, great having you in the studio. Thanks so much for visiting us here at 731 Lex. Ashmore, Head of Research, Gustavo Medeiros. Coming up, Dollar General sees challenges ahead next year, but is improving on a comp sales and average spending per visit basis. Earnings details ahead. This is Bloomberg.
All right, let's take a look at some consumer-related earnings today. Dollar General cutting guidance for 2025, but is improving on comp sales and the average customer spend per visit. But then you take a look at Kroger. It's narrowing its guidance range as it sees near-term uncertainty for the economy. It's also awaiting a court decision for its potential merger with Albertsons. We've been waiting on that one for a while. Let's talk about it with Billy Lipschultz. He's here to break it all down. Billy, a lot of big movers.
A lot of big movers. Well, not that many big moves, though.
Hey,
Kroger.
we're trying to sell this.
A lot of excitement. A lot of big movers if you look at how they've been performing on a 12-month basis. Kroger up 35%, while Dollar General down 41%, but still seeing kind of that bifurcation between consumers' ability to spend. When Dollar General's CEO is on the call talking about difficulty for people to be able to buy products, you see the impacts from the hurricanes playing out for that company. And as you mentioned, with Kroger, all eyes are on what a new administration could mean for that Albertsons merger.
Going back to Dollar General for a minute there, state of the consumer, we were talking a lot on this program about how most of America still makes less than $100,000 a year. They're really feeling the pinch. If you look at the Walmarts of the world, you're seeing above that line, really buy in more and more to Walmart. But you see not just Dollar General getting a little bit of love today, you see Five Below rising the most that it has in at least 2 years. What exactly is going on that could improve the picture a little?
Well, the big thing, Shonali, is that Five Below typically caters to teens, so younger people who have, $20 in their pocket that can go buy an iced tea and a nice speaker or some kind of fun thing. Like when you look at the actual dollar spend and the people who are going to the different stores, your client base at a Five Below is very different than someone who is trying to get by at a Dollar Tree or a Dollar General, where maybe they're buying groceries, again, versus what I would say is more discretionary spending typically at a Five Below.
Go on.
No, I just want to...
We have the same thought.
Yes,
it's
airlines,
on
airlines. So, first of all, I thought it was really interesting to see American Airlines come out today and adding to the Southwest and JetBlue, optimism. And then Katie pulled up a chart this morning.
I'm freaking out.
That kind of blew me away. I mean, it's not Bitcoin level, to Benny's point.
Pretty close.
But United Airlines has been on an absolute tear, especially compared to its peers. You can see here that Delta hasn't gone up 150% year to date, and American Airlines is really going nowhere over the last 11 months. So what's going on?
I think there's a divide. I full disclosure, typically fly United, and I think that United
Oh,
has.
it's because of that?
Well, I'm the exact driver because they have a hub in Newark, New Jersey that makes it easier for me to go to California. No, but I do think it gets back to, again, the divide of spending power. So if you're selling premium seats and if you're selling kind of the upscale consumer, whether that's someone who's flying for business or someone who can simply afford first-class seats, that's kind of been dividing it. Again, not looking too in depth at what the differences in these businesses are, but you've seen that with Southwest, which caters more towards a U.S. Domestic traveler who's maybe on a budget, whereas United has these nice big planes that fly kind of around the world. And that's
they're okay. They're not that great. And by the way, I know you live in New Jersey, and these two ladies hail from the armpit of America. Why doesn't...
I said that once this year, and now I will never live it down.
New Jersey has everything.
Yeah, but not a great airport. Don't you think they could really make improvements there? Not that JFK and LaGuardia...
I was going to say, I love Newark. I have a great experience
You're
in
out
Newark.
of touch here, Matt, I gotta say. He sold Bitcoin. He doesn't like Newark Airport. Bailey Lipschultz, it's great to see you. That is Bloomberg's Bailey Lipschultz. He covers everything for Bloomberg News.
SPACs, meme stocks.
Anything you can name, anything shiny. Anyway, coming up next, TD Bank missing estimates thanks to a weak performance in the U.S. We'll take a look at the Toronto-based bank next. This is Bloomberg.
And it's time now for the Wall Street Beat. TD Bank stock is taking a tumble this morning after missing estimates and suspending its growth guidance. For more, we are joined by Bloomberg's Christine Dobby in Toronto. And this adds to pressures. There have been a lot of regulatory concerns, and you already have a stock now down in the U.S. more than 11%. What is the future of TD Bank in this country?
Good morning. Yes, very disappointing morning for TD today. As you mentioned, they did miss on their quarter this morning, but I think analysts were really hoping to see some sense of how they would operate under the new conditions that came along with the anti-money laundering settlement that they struck with the U.S. authorities in October. And instead of getting any guidance on how the bank expects it will do going forward, we were told today that their growth estimates have been suspended, and they're now undertaking a broad review of their business. And there's not a really clear sense of when we'll get a better sense of how this business will operate going forward.
You do still have the incoming CEO addressing analysts on a call this morning, and incoming is another sign of uncertainty, isn't it? There's a leadership change underway here. How is he going to walk in with a fresh set of challenges?
Yeah, and it's interesting because this is a long leadership change. It was announced a couple of months ago, and he won't officially take over until April, so he's still in a bit of limbo. But as you said, he is addressing analysts on the call today. He's got a tall order ahead of him. Morale at the bank is quite low, and I think boosting that will be one of his chief tasks. He said today that he's been looking at all aspects of the bank, and as they do this review, he said, everything's on the table, and they do plan to have an investor day at some point in the second half of 2025. But yes, he's got a big job ahead of him.
Absolutely. Christine, thanks so much for joining us. Bloomberg's Christine Dobby talking to us about TD Bank. Over the last 5 years, the stock is up 3%. Coming up in the next hour, Morgan Stanley's global co-head of investment banking, by the way, that stock has done a heck of a lot better, joins the show. So Sonali is going to interview Eli Gross. We're looking forward to that. And then, Wall Street superstars keep on coming. Apollo partner and chief client officer Stephanie Drescher joins us as well. Don't turn the dial. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
Coming up, the revival in deal making. Morgan Stanley's global co-head of investment banking, Eli Gross, is going to talk to us about M&As, IPOs, and more in just a moment.
Plus, France's Marine Le Pen revives hopes for a budget deal. We'll bring you part of our exclusive interview with the far-right French leader.
And investors gear up for the all-important jobs report tomorrow morning. The labor market may have bounced back after a big hit from strikes and storms. Those numbers coming out 8:30 a.m. tomorrow. Let's take a check on markets right now, though. You can see the S&P 500. It's still quiet, but the color's changed. It's green now, up, I don't know, less than 0.1%. I'm going to call that unchanged. You take a look at the NASDAQ 100, your big tech index, not quite there yet, down about 0.1% right now after a big rally yesterday. We'll see how that trade evolves. And then you take a look at the bond market. Yields higher right now to the tune of about 3 basis points or so. We're still relatively low compared to where we've been. The 10-year yield camped out at about 4.20, Shonali.
And Katie, we're going to turn to the deal-making environment because things are looking up. You have M&A volumes rising 70% in November compared to the prior month. That's according to the latest data compiled by Bloomberg. And if you look at the whole year, if you look at this year, we're already past where we were in all of 2023. So things are looking up. And joining me now is Morgan Stanley Managing Director Eli Gross. Eli started at Morgan Stanley's M&A department in 1998, has served as co-head of global investment banking since 2022. And so you've seen a lot of cycles. We are now on the precipice of not only a new administration, but all of the new regulators that would come with us. Would come with that. You have investors looking forward to a new antitrust environment. They are betting on investment banks. They are betting on investment banking coming back. Morgan Stanley has consistently been one of the top 3 global M&A firms. Right now, according to Bloomberg's data, you stand at with a 5th of global market share, at least, more than a 5th. So how good does it get from here? Eli, what can you tell investors?
Well, first off, Shonali, thank you for having me. And you're absolutely right. What I would say is that we have a macro backdrop and an incoming administration that sets up for a tremendous rebound in deal-making activity, really a continuation of what we're already seeing. Not surprisingly, the last couple of years, high rates on the back of inflation. We had uncertainty with respect to earnings, geopolitical uncertainty. We saw deal volumes for M&A drop to the lowest level as a percentage of GDP in 30 years. But fast forward to today, much different picture. Not perfect, but better. We started the rate cut cycle. Earnings growth for the S&P next year going to be low double digits. Financing markets are open, wide, and deep. And financing costs are at all-time lows. So as an example, in November, highest level of leveraged loan issuance we've seen all time. And then finally, you referenced this a little bit, but it's very important. As we're talking to CEOs, investors, and boards, what we're hearing is increased confidence with the new administration. The new administration is focused on growth and focused on deregulation, and those are both very helpful for our deal business.
But does that mean all gates are open? I think one major thing that investors are sitting here and grappling with is, does this mean the antitrust environment will be open for big tech? Will it be open for foreign buyers, especially when you see the president-elect still cracking down on things like Nippon Steel in the U.S. steel pursuit? Do you think that anything can get done, or are there still limitations?
It's a great question because there's no doubt that the antitrust regulatory environment has been a headwind to M&A over the last couple of years. With the incoming administration, I think what we would say is we expect it to be a much more constructive backdrop. That doesn't mean that the administration is not going to focus on regulatory where it makes sense. But what we are saying is that the constructive backdrop will be because CEOs and boards and investors can look at a set of rules and regulation that feels like what they've seen in the past, as opposed to what we've seen over the last couple of years, some new ideas to challenge deals, which resulted in elongated timelines and uncertainty, and boards and CEOs that we speak to don't want to enter into uncertainty.
When you think of uncertainty, you mentioned one thing that has cleared up, that is financing. It's pretty amazing to see the leveraged loan markets come back the way that they have. It indicates that investors are willing to take on risk. But one part of the market that has not come back, private equity deals. It has started to, but not nearly in the way that the market would need to show some signs of success for those buyout firms. What are you talking to among clients? How willing are they to put assets up for sale? And do they have to take haircuts on those assets?
Well, it's a great question. No, short answer is private equity firms, venture capital firms do not like selling things at a loss, even if their LPs are asking for the money. What I would say is, and as you've reported many times, there's $4 trillion of private equity capital ready to be deployed, and it is being deployed. So think of Silver Lake buying Endeavor, Think of Blackstone buying AirTrunk. But the question is, when are the assets coming to market? And to size that, just in North America, there are 1,200 assets, over $1 billion in private equity portfolios. And the hold period for 2/3 of those assets is over 5 years. The good news is we're seeing it happen. As we sit here right now, Sonali, we have bankers around the world, across industries, drafting S1s for companies to go public. We have them writing investment memoranda for companies that will be sold. And as examples, KKR took OneStream public, a successful IPO. Carlyle took Standard Aero public. So it's happening. And the private equity business, they raise money, they invest, and they add value. But the important thing is to get the money back to investors.
So your bankers seem to be working through the holiday season then, it sounds like.
Absolutely. It's a very busy time.
So you have S1s being prepared right now. How many of them, how big? Because there has been, your CEO actually just a couple months ago said to me that these IPOs are going to get bigger. They're going to be bigger and bigger IPOs. Companies have been waiting longer to go public, yet you have so many in the pipeline. What does that pipeline look like?
Pipeline is growing, and things are actually happening. So you're right. Slower IPO market, but the IPOs are actually up 50% year over year off a low base. But why we are very confident is that long-only investors, a BlackRock, a Norges, a Wellington, they've been playing in the IPOs that we've taken to market, and they're working. So think of big IPOs like a Lineage Logistics that we worked on. That's working. Think of flow equity business. So as an example, Alibaba, $5 billion convert, or Walmart selling $4 billion in a block of JD.com. So investors are making money on the deals. Tech has been slower. And as we all know, tech is a big part of the equity market and of IPOs. So yes, we had Reddit this year. We led that. We led Astera Labs. But the S1s I'm talking about, a lot of those are based in Menlo Park. And so we're very optimistic.
Well, when you're a tech company and you're looking to 2025, what are you most excited for? The idea of going public or the idea of being able to sell to a large strategic buyer once more? If you're having these conversations, do you also have a pile of $5, $10, $20 billion deals sitting in the pipeline right now, too?
Yeah, I would say the pipeline is full across size ranges. And you talked about strategic buyer, which ties back to your regulatory question. You know, strategic buyers are very open for business. Strategic buyers right now are sitting on $7 trillion of cash. The balance sheets are underlevered, and they are looking at things like technology add-on acquisitions. Strategic buyers need growth. You think of Verizon buying Fortive. Strategic buyers are looking around the world for assets. So the technology sector has seen lower levels of IPOs, but really lower levels of M&A as well, just because the regulatory environment has tougher. There is no question, and I've met with several technology CEOs over the past couple of weeks. They are looking at those tuck-ins, they're looking at those mergers of equals, and AI obviously is a big theme, but there are many other themes that are going to spur that on.
It's funny to say, but as somebody who's covered investment banking for 10 years, $10 billion seems like a lot of money, but relative to what you've seen with deals in history, it's kind of small. I mean, you know, can you see those $50, $60, $70 billion deals once again? We haven't seen any of those this year.
I think you will. Just as an example, my Thanksgiving weekend, we had 3 calls of deals all over $25 billion. So big deals are here. And in fact, we saw a decent amount of large-scale deal-making activity. You know, think of some of the energy deals we've seen over the last year. So I think it's going to continue. Investors will look at deals. Boards will pursue deals if there's growth, a strategic logic that makes sense, and the financing markets are wide open, and size is not a constraint by any means.
Certainly sets up for a really very interesting 2025. That is Eli Gross of Morgan Stanley, co-leads the investment bank there. And coming up, you're going to want to stick with us because we're going to bring you an exclusive with Marine Le Pen, the far-right leader in France, giving some investors hope for a quicker resolution to France's political wrangling, which has, of course, stunned the world over the last few days. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Syrian rebels have notched another blow against President Assad after forcing a retreat by the army from the city of Hama. According to Syria's main news agency, the city is halfway between Aleppo, which rebels took last week, and Damascus, which is obviously the capital. The fighting represents the biggest threat to the Assad regime since 2015. And Canada's second biggest bank rips up the script. TD Bank has abandoned its medium-term growth targets we were telling you earlier this hour. The company instead opting for a strategic review as it awaits its new CEO and after settling an historic money laundering case with U.S. authorities. Finally, Tesla CEO Elon Musk is reportedly meeting with incoming Senate Majority Leader John Thune. Musk and Vivek Ramaswamy, who are set to co-direct the Department of Government Efficiency, which is for some reason pronounced Doge, will speak with House and Senate members today about their department and its proposed spending cuts. Katie?
All right, let's turn to French politics because French President Emmanuel Macron is now searching for a new prime minister after lawmakers passed a no-confidence motion against his government. Far-right leader Marine Le Pen and her National Rally Party are set to benefit the most after teaming up with a left-wing coalition to topple the French government. Bloomberg's Francine Lacroix sat down with National Rally leader Marine Le Pen in an exclusive interview and asked her if getting the deficit to 3% of GDP in 2029 is far-fetched.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes. Once again, these are simply promises, and they know very well they can't keep to them. Mr. Barnier made this promise, and in reality, his budget worsened the deficit by 12 billion. So, if we don't make significant, intelligent structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with these two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be?
C'est l'affaire de quelques semaines.
Well, it's a matter of a few weeks. We'll discuss it with the new Prime Minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxes, he hits sick people, retired people, he hits everyone. And at the same time, once again, there's zero savings from the state. That's inadmissible.
All right, joining us now to talk about this is Alan Katz, Bloomberg's Paris bureau chief, and I have a lot of questions, Alan. I'll start with what she just said. You can't ask the French people to pay the bill for the mistakes of their leaders. Who would then pay that bill?
So what she's really trying to get at is that she claims that Barnier's budget plan was really going to hit middle class and working class people in a way that she found unacceptable. And so her argument would be for a budget that really focuses more on hitting, I'd say, large businesses, very wealthy people. You don't forget that her party is called a far-right party, but in fact, in many ways, it's sort of the way that Trump argues things. Like she is for a lot of, I'd say, populist measures, but she really also tried to put herself as a champion of the working class and of the middle class. And her argument is that you need to do things to improve their purchasing power and not try to load them up with extra taxes. So that's her argument. But one of the things to point out from what she was just saying is that she is really trying to come off as someone who is very reasonable, so someone who has their own economic plan and someone who's going to be sort of constructive going forward. She's trying to present herself very differently from, say, the far left, because she's saying she can work with whoever the new person might be as prime minister and try to get to a budget relatively quickly. That's very, I wouldn't say conciliatory, but it really is. She's trying to be constructive in her expressions, at least, regarding Emmanuel Macron and whoever he picks as prime minister. By the way, Alan, you bring up the taxonomy. Obviously, as journalists, we pay close attention to the words that we use. And I've been wondering, is it still fair to call Le Pen and that party far right as the center, shifts in France as well as around the Western world? So that's a good question. I mean, in some ways, it depends on what you mean by far right. The way that the French parliament is laid out, her party literally sits on the far right of the parliament chamber, and that's where the terms sort of left wing and right wing come from, is where those parties happen to be sat. centuries ago. But that's how it sort of got started. But her party is still far right in a lot of its social measures, particularly in terms of immigration and wanting to reduce any benefits for immigrants. It's on economic terms, though, it's not at all far right. On economic terms, you could call it populist, perhaps, but you can't really call it far right. It's actually much more left-wing than you would expect on economic terms. They're really for going after corporate earnings, particularly, they want taxes on share buybacks. They want to increase taxes on high earners, and they want to give money back to working class and lower middle class people. So economically, they're not far right. Populist, perhaps, but not far right. But socially, or on non-economic issues, they remain sort of far right in the global French system.
Isn't that fascinating?
It is. I was going to say it's really interesting to see the evolution of language here and how we refer to these different political camps. But let's spin this forward, Alan. Of course, after that no confidence motion, what do we know about the search for a new PM? Who are we potentially talking about?
Well, we have a story out today with several possible candidates. Someone in the newsroom was joking earlier today. It's a very diverse bunch of middle-aged white men, but nevertheless, those are the people that are being discussed. President Emmanuel Macron is going to be on TV at 8 p.m. tonight. He may or may not announce a new prime minister. The way it works in France is that it is up to the president to name the prime minister. There is no timeline for it. He can do it immediately. He can wait. This summer, it took him almost 2 months to find a prime minister. Their argument is that he really needs to go quickly because he needs to find someone to take the attention off of him and what Macron has done to help create political chaos in France by dissolving parliament 6 months ago, or a little bit less than 6 months ago, which resulted in sort of these three left, middle, and right-wing blocs that really can't get along with each other. And he needs someone to really push forward and get a budget. The way it works in France, too, is that the prime minister and the government is in charge of the budget and domestic issues. The president is not. So he needs a prime minister to really put forth a budget. And France doesn't have a budget for 2025. 2025 is less than a month away. They really, really need to get on that.
Alan, we thank you so much for your time. That is Bloomberg's Alan Katz in Paris. And of course, you can find details of the Macron address tonight on LiveGo on your Bloomberg terminal if you want to be following along. Now, still ahead, who was the most streamed artist on Spotify this year? Matt might have an idea. We probably weren't listening to what he was, though. We're going to reveal all of that up next. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. Let's get a check on these markets. And there's not much to say. The S&P 500 pretty much unchanged right now, maybe a touch lower. It was a touch higher just about 30 minutes ago, but you can see we're drifting along here in a low volume sort of trade. Same thing, too, if you take a look at the NASDAQ 100. You think about the catalysts that we have coming tomorrow morning at 8:30 a.m., that all-important jobs report. These lines could look a lot different 24 hours from now. You take a look at the bond market as well. The 10-year Treasury yield a little bit higher, about 3 basis points or so. Pretty calm trading compared to the last several weeks, the last several months. The 10-year Treasury yield camped out at 4.20. Meanwhile, it's time now for Social Climbers. The company's making waves this morning. And first up, a high five for the discount retailer Five Below as it boosts its full-year sales guidance, and it's also named the former Forever 21 head, Winnie Park, as its new CEO. You can see shares up about 12%. Next up, we have the diamond retailer Signet Jewelers warning that its revenue may fall short of expectations in the coming quarter. It's the parent of Zales and Blue Nile. It also said that competition took a big bite out of results. That's taking a big bite out of shares, currently off by about 12.5%. And finally, Spotify Wrapped. It's the annual summary of users' listening habits. It was released yesterday. Actually, that's when I got mine, at least. And surprising no one, Taylor Swift comes out on top. The pop star ranked as the most streamed artist globally in 2024. I think she won last year as well. But in any case, other artists high up in the rankings included The Weeknd, Bad Bunny, Drake, and Billie Eilish. And Matt, I know you use Apple Music, but I know that Taylor Swift also made your top list.
Yes. I mean, credit to you. I started listening to Taylor Swift after you said You think she's the Dylan of our generation, which I think is
my
insane.
generation.
True, your generation, different generations. But she came in number 6 in my, I use Apple Music, but they did a similar thing. I got it this morning. Obviously, The Grateful Dead is way up there on top for me. Culture Wall was in 2nd place. Sturgill Simpson in 3rd. But Shonali, what about, did you get yours?
Nikki Lane, have you guys heard her?
No.
I know, we're getting out there on the country records here.
But she's your number
Orville
1
Peck.
spot for the whole year? You listen to her more than anything else?
Why are you judging me?
I'm just...
Taylor Swift, I'm embarrassed to admit, was my number 1. But she released a new record this year, so it skews towards that. But I had Third Eye Blind in there
I love
as
it.
well, and also My Chemical Romance. So I had some throwbacks.
Who else did, I mean, no one's heard of Nikki Lane, but who else did you have?
I don't know, but I was trying to look to see who else I was listening to, but Mariah Carey's pretty high up on there. I mean, it's almost Christmas
Even
time.
before Christmas?
Her Christmas record is...
This is
Chef's
great.
kiss.
This is
The
so
best.
smart of Spotify, though, because everyone talks about Spotify for at least an entire day.
Or Apple Music.
They're going to be talking about it on Inauguration Day also, with all the live things they're doing. Anyways, coming up, we're going to speak to Apollo. Stephanie Drescher is going to talk about private markets next. We're going to switch gears. Stick with us. This is Bloomberg. Now, Stephanie Drescher is Partner, Chief Client and Product Development Officer at Apollo, and she's on a mission to make private markets more accessible to the public. Apollo has said now, quote, private market strategies can deliver excess return per unit of risk while adding diversification to a portfolio and providing access to a broader investable universe with less volatility. Now, the question is, how do you get your hands on it? Stephanie joins us now to explain how Apollo is trying to morph these products to make them more accessible. We kind of used to joke around a couple of years ago. I was talking to you and I said, how soon can you buy Apollo on your iPhone?
I remember that.
And you said you can do it pretty soon. How do you think about how soon these very hard to access investments can be made that liquid and that available?
Right. Well, first off, thank you for having me and great to see you. Great to see you again, as always. So look, since we met, I do think we've come a long way in a short period of time. We're not there yet. We're not yet on the Apple phone, but we are getting closer and closer to that buy button. And as an industry, and certainly at Apollo, if I think about where we were just 3 years ago, actually when we spoke early on, we really had a white piece of paper for how we were going to shift from what was historically providing these alternatives, private market exposure to institutional clients. And that's a mature market, and the excess return has served them really well. But to create that greater access. And since then, we have invested $1 billion of our balance sheet into wealth. We've actually developed now 11 semi-liquid strategies to allow for that greater access across private credit, private equity, real assets. We have grown the team from fewer than 10 to now 140, and we've actually announced publicly that we're going to double that in the next 5 years. And we are also already at about 30 billion in terms of AUM with a goal of multiplying that by 5 times.
Mm-hmm.
So we've come a long way in a short time.
Yeah, you've been hitting the road running. When it comes to what the clients are trying to buy,
yes,
what kinds of products are they flocking towards? Are they going to things like private equity when you could just buy into the S&P 500? Or are they going to things like private credit where that seems to be more elusive to investors, but they know that Wall Street is nipping at the heels of it and you guys excel at it?
Yeah. So look, I think that there is interest for both private credit, private equity of different types, as well as the real assets. When we think about the equity markets, for example, I do think there's a fundamental rethink in terms of the future of investing. Historically, public was considered safe, and private, because it was more illiquid, maybe perceived to be more complex, was riskier. In today's world, when we look at the public markets, when we look at the volatility, when we look at the concentration, NVIDIA, 1/3 of the return, Fabulous 5, 55% of the S&P gain. When you look at the total number of companies globally, though, 90% are in fact private.
Right.
So in a world where I believe investors are looking to plan for retirement, individuals, right, plan for retirement, build wealth. The reality is that private markets are no longer a nice to have. And both, in fact, can be could be safe and risky. It's just a matter of degrees of liquidity.
Right.
And so we are seeing more and more interest so that investors ultimately can develop and build for retirement, have that excess return, more diversification, which lowers their volatility. And the backdrop of the public markets, I think, has really fostered that.
You make a ton of great points, and I actually think about the shrinking of the public equity markets all the time, just in terms of the numbers of companies. But aside from liquidity, aside from safety, I do want to talk about just pure returns, because you take a look at junk yields at 7% right now. Sonali mentioned that the S&P 500 is up 28, 29% on a total return basis year to date. Are you really finding better returns in private markets?
Look, we look over the longer term. And I think when you look at 10-year, 15-year, 20-year results, you do see that outperformance. And especially as individuals look to plan over decades to plan for the wealth creation to meet their retirement and long-term goals, you know, if anyone was looking in 22, it would have been a very opposite experience, right? So we look over the long term, and there we absolutely see it for both the credit markets as well as the equity.
I wonder why you don't just buy, you know, we talk all the time about if you're interested in Bitcoin, you could buy the ETF, but you could also buy MicroStrategy, right? And if I'm interested in private assets, why don't I just buy Apollo? You're up 300% over the last 5 years, 360% if I'm reinvesting dividends. So don't I get just fantastic exposure buying your stock or Blackstone or KKR?
Right. Well, I'm sure they would get a great experience as an investor in our stock, but it is a different experience, right? That is one of holding a public equity security. What we're referring to is truly getting exposure to those private credits, to financing private companies, ultimately equity in private companies that have a different profile, different volatility, different streams of cash flows. So it's different roles in the portfolio. Ultimately, we do believe that there is a convergence occurring in terms of public market exposure and private plays a role as a replacement for a portion of both the fixed income and equity allocation.
Also not as regulated, right? So should all investors have access to private investments?
You know, our transparency, as you look at our Apollo Debt Solutions, which is a private BDC, the transparency and the regulation, I do believe, serves investors extremely well. We always want to make sure that it's an appropriate allocation in their portfolio, but the ability to get that return stream and the diversification, we do believe is very important. And it is growing in terms of accessibility. So there are different structures out there.
Speaking of regulation, you know, one thing we've been talking about a lot on this show, especially this morning, is that you're about to have a new SEC chief. On the board of Apollo has long been Jay Clayton, by the way, too, so very familiar with the changes over at the SEC. You have products in market now that are waiting approval from the SEC. Everyone knows about the ETF. I know you guys are pretty limited on what you could say about that. I actually want to go somewhere else, though, because less people talk about differences, for example, at the Department of Labor. Because that difference would mean, okay, can you finally start seeing private assets in your 401k? Is that conversation going to start picking up, you think, again? And you know, there's a lot of controversy, a lot of debate about whether it should be possible.
Look, when you think about someone planning for retirement over a 50-year period, yet the options for their 401k account are exclusively daily liquid. The institutions have had the benefit of that private exposure as a part of their allocation for decades. And I've seen it from the institutional experience I've had. I do think that the conversation is picking up. We are seeing it, and it can be a meaningful excess return. And the reality is that what we're seeing, kind of a shift, is the historical view for 401ks of focusing in specifically on fees, right? And the absolute level of fees. More recently, the fiduciaries are considering the outcome, the net return for their plan, And that's super important, right? Because ultimately you want the outcome to be the best one and serve the retiree. So a portion of the portfolio, we do believe, can back away, step back from that daily liquid exposure in order to achieve these benefits.
So all of those arguments make sense. And just for some context, I cover ETFs, and the 401k system is like the last pioneer because it's really just built around mutual funds. And, you know, State Street, for example, which Apollo knows well, is trying to work to actually put ETFs in 401ks. But it seems like just such a hard system to crack. I talk to a lot of people about it and they just don't see it happening. So when you talk about these arguments, I mean, is Apollo lobbying here? How do you actually see this happening?
It's in conversations with our investors at this point where they really want to do what's right for the plans that they're managing. And thinking about the options that they have in private markets is an important tool. And we've seen it in so many other applications. And ultimately, given arguably the retirement crisis that we have in the U.S. and the $13 trillion that is ultimately managed in 401k, it's worth a strong consideration.
Stephanie, we thank you so much for joining us here in studio. We're looking forward to following how far this goes. That is Stephanie Drescher of Apollo. And Katie, to the point you've been making, something I've been wondering just this week is if you have BlackRock going over and buying HPS, then do they start pushing harder to put those private assets in 401k plans?
In 401k, in ETFs, the entire ETF industry is just waiting for BlackRock to drop a filing. We had 2 private credit CLO ETFs launch yesterday, which is not true private credit, but it's part of an answer, but still waiting on BlackRock to make a move here.
Goldman, we're talking to next week about all this stuff, and them too. It's like, when are you going to make the move?
Yeah.
Yeah, that is interesting stuff, and I know you.
Is it interesting?
I know you ladies think about this a lot. Great to have Stephanie. Great to talk about private markets. I love
and
actually
you
the
want
idea.
to talk about his taxes.
No, I love the idea of the convergence. I love the idea of the convergence, indeed. I just want to bring up one interesting headline that I'm looking at on the Bloomberg terminal. According to the FAA, Newark Airport, which we've been talking about in this program anyway, is going to close between 12:15, so just after noon, and 6 p.m. So a 6-hour stretch.
Wow.
The airport will shut down.
Is that staffing issues? What's
Refurbishing,
going on?
maybe?
We got to follow up on this.
High winds. Apparently, it's high winds. So
Matt loves being right.
Coming up, a story about affordable housing. Former Vancouver City Councilwoman Colleen Hardwick discusses how people are being priced out of that area. It's in Canada. This is Bloomberg.
Matt this morning.
All right, it's time for our daily Wall Street Week conversation. And Vancouver, Canada, is facing one of the most extreme housing affordability crises in North America. Romaine Bostick spoke to former Vancouver City Councilwoman Colleen Hardwick about what's contributing to the crisis.
We have to step back and think about what we're trying to do here. And from my perspective, we need to be seeking balance in the way that we're approaching our urban development. And what I'm seeing is increased pressure to promote growth rather than to balance growth. And that's really at the heart of the problem. The legislation, though, particularly bills 44, 46, and 47, are undermining local democracy, removing, for example, the ability to have public hearings and silencing the public, the people that live here, in the process. I think that's fundamentally misguided. I think that the provincial government, along with the local government here in Vancouver, are listening to the wrong voices. They're not listening to the people that live here. They're listening to the people that stand to profit for producing more housing. And we really need to unpack that and think carefully about what we're trying to do here.
If you're not producing more housing, then how do you address the lack of available housing?
Okay, so let's start with looking at the housing data, looking at how population growth correlates with the need for additional housing. In Vancouver, the city of Vancouver proper, we've been looking at a 1% per annum increase in population. And that has been translating every 5 years in the census to about 5% per year, 10% per decade. And the housing has certainly kept up with that. The problem is that we've been producing luxury condos for the international market. Like many gateway cities, Vancouver has become a destination for parking global wealth. And this approach of producing more high-end housing has just widened the gap between global wealth and the local economy. So rather than just pitching around housing crisis as a general statement, we have to unpack it, look at the data, and think about what we really need here as a city and as a region.
Do you actually see it as a crisis?
I see it as an affordability crisis. I have 2 kids and now 2 grandchildren trying to live in Vancouver. All of my siblings, we were born and raised here, have left. I'm the only one remaining. Only 2 of my cousins are still living here. People are being forced out, and it's an unattractive place to live from an affordability perspective. And again, I can track this back to 2008 and the financial crash and the impact that it had on the city of Vancouver's business model. And many of the moves that have been taken both by the city and now by the province have exacerbated the affordability problem.
And that was Colleen Hardwick speaking with Romaine Bostick. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. All right, let's get a check on these markets. Pretty soggy if you take a look at the S&P 500, down about 0.1%. The NASDAQ 100, big tech names down about 0.2%, and quiet in the bond market, though we are below 420 on the 10-year yield. Yield's higher by about just 2 basis points coming in there. Let's talk about what could change this setup, though, and that is, of course, the jobs report tomorrow morning. We got U.S. jobless claims a little bit earlier. They rose to the highest in a month last week, but that was a week that included Thanksgiving.
Highest in a month, huh?
Wow, we're really stretching here, but I promise that tomorrow's monthly jobs report will be a little bit more interesting, especially when you think about what we saw at the most recent report, Mike McKee, just 12,000 jobs. That looked pretty noisy. What are we expecting tomorrow?
A big rebound, basically, because all the people who couldn't go to work because of the storms and the strikes in October are back on the payrolls. So the only question is how many people were actually off and how many are now back. The estimate has been moving up all week. We're now at 218,000. We'll see where we end up tomorrow and whether or not it gets as high as the highest forecast, which is 275 at the moment. But the Fed will look through that. They're going to look at the unemployment rate, which isn't affected by
Feels
the
like
storms.
The Fed has been looking through a lot of things on their quest to cut rates.
Yeah, aren't they data dependent?
Yeah.
They're data dependent. It's on their dashboard, as they like to say, but they know that this is a rebound and that last month was noisy. But the unemployment rate is not affected by those things. So they're keeping an eye on that. And that's been their metric all along, is the unemployment rate. It's lower than they thought it would be by December. So if that stays the case, they're going to be happy with where the labor market is.
It's lower than it. I mean, historically, it's still very low, right?
You could still argue we're at full employment here.
I think I probably would. Is inflation a concern for them? Because you've seen inflation readings that are a little bit hotter than expectations.
A little sticky.
Yeah, in the last couple of weeks, we're hearing more about that again, the inflation numbers and the recognition that they're not going down. They're not going up, but they're not going down. And so the Fed is looking at that. And that's one of the reasons you hear from people like Alberto Musalem yesterday talking to me, saying maybe we need to pause, to keep the foot on the brake a little bit longer, just to make sure we get down to 2%. When you ask them about labor versus inflation, they say inflation's our goal. We got to get that down to 2%.
As anxious as I am about December 18th, I am anxious more about next year. And so if you think about market expectations.
You got to just Like meditate, you know, center
I
yourself.
meditate every morning. We talk about this all the time. So anyways, you know, when we think about the way the market is pricing things, you don't see the implied rate going to 3.55%. That is the trough until the middle of 2026. Is the market going to have to just throw out some of these expectations regardless of what happens to 2026, to December 18th?
Markets exist to overreact. The Fed reacts, the markets overreact. And I was just talking with a senior Fed official yesterday who was saying that doesn't bother us. We know that's what they do. At every data point, they're going to adjust. Whereas the Fed just has a meeting every 6 to 8 weeks, and they'll just see what happens up to that point. So remember last January, we saw, what was it, 6, 8 Fed moves forecast by the markets, and the Fed just looks through that, to use a phrase, and just does what they need to do. So the markets are going to have to adjust to what comes every day.
Yeah. All right. That fight against the Fed, it just continues.
Spells
Mike McKee.
volatility.
Yeah, it's a lot of fun. It gives us something to talk about. Mike McKee, we'll see you tomorrow morning. That, of course, is our economic and policy correspondent. Let's talk about Lululemon. I am so interested to see their earnings after the bell. Of course, there's a lot of focus on how the stock might perform. You can see there's a preview out on the Bloomberg terminal, potentially facing sluggish sales due to fewer new items. This stock has gotten absolutely punished this year, down 32% year to date. You think about a company that needs some good news.
Who do you think they're most competing with?
I don't know. I mean, it feels like all of the retailers have some form of athleisure now.
Abercrombie and Fitch.
Exactly. What's that other one? The new one, Vuori? It's not public, but yeah, I've heard that is the new hot thing. Athleta as well is stiff competition.
Isn't that non-alcoholic beer?
Athleta? No, that's Athletic Brewing.
Close. Close.
Yeah, I don't.
That's what you drink when you wear your
Athleta's a
leggings.
Gap brand.
I don't really know much about the yoga pants market.
Really?
Maybe you should.
But I'm happy about it. I celebrate Lululemon.
That's great. Well, Lululemon would like you to come into their store because they do have a pretty decent men's section as well. This is just anecdata, but you know, my husband shops there. Yeah.
Is it not a little bit embarrassing?
No, he looks great.
To wear women's yoga pants
He's
as a
not
dude?
wearing women's yoga pants.
They have just normal way shirts, like collared shirts.
You clearly have never been in a store. There's one at 86.
Yeah, if you're buying Tommy Bahama, you're probably not buying Lululemon.
I mean, it's like, well, for my
Tommy
generation,
Bahama
it's
does
like
slap.
guys wearing tree torns, right? It's not really.
Wait, what is that?
No idea.
So you're too young to understand, but it was like a very popular, more feminine women's tennis shoe. And they did make tennis shoes for dudes, but you just didn't really.
I want to go back to another set of breaking news because you were talking about it before. Want to bring it to
Newark?
Yes, Newark Airport. So they are actually going to be operating as usual now, commercial flights taking off and landing. The closure mentioned by the FAA refers to that from 12:15 to 6 p.m. The airport is not allowing private planes and non-commercial flights to land or take off.
Well, when I talk about an airport, I'm only talking about private aviation.
Yeah, come on.
Commercials for the plebes.
Anyway, what's coming up tomorrow?
We're going to have an all-star lineup for you tomorrow to break down the jobs report, including BlackRock's Rick Reeder and Gabriela Santos from JP Morgan.